I hope you're enjoying your day. We now are talking about portfolio value creation, how to go further, how to create value, how to impulse value as a GP, of course. I'm glad to welcome on stage Fabrice Dumonteil at Eiffel, but also member and a key player at France Invest, the French Association for GPs. Michel Semenzato, who is founder of Wise Equity. Thank you, Michele, for being with us. And François Barbier, who is a managing partner of 21 Invest. Actually, it will be a lot about France and Italy today, I think, but not only. Should you have any question during the meeting, please just raise your hand. We want it to be informal, and if you need anything, just raise your hand. When we were talking about portfolio value creation, of course, we thought about the current position in the market, the current situation. And maybe, François, the first question is, for a good transaction, for a good portfolio value creation, you need to enter at the right price. And right now, you're experiencing, as a buyer, very high valuations. How do you take that into account when you're buying and building an angle?
Thank you for the question, Mathieu. I don't think we can say that it's the right price.
You already got applause.
It's not the right price, it's the pay we have to price in the market now, that everybody in the room knows that it's, of course, the top of the market. Maybe even higher tomorrow, nobody knows. The only thing we know is that as soon as the interest rates are high, we will have high valuation. So we have to deal with that. It's not what we like, but we have to deal with that. And what I note in being also an observer of the market is that we have typically two behaviors in the market. You can deal with that in having a strategy that you deploy to buy at a lower price. So it means that you need to target sectors that are maybe less attractive or companies that have some
hidden pearls.
Drawbacks.
Hidden pearls.
Yes, hidden pearls or whatever. It's an additional risk, I mean, that's reflected in the price. It is a strategy. And the second one, that is our, is to pay the full price. So it means that we invest only in premium assets. So it means that we know that we'll have to pay high pricing. And if you start with that, it means that you need to boost your companies. No surprise, you cannot expect to have increase in terms of multiple. It can happen, but it wouldn't be reasonable. You have even more to probably consider to have a discount at exit time if you pay today the current market multiples. So it means that you need to focus on growth. And on that, for us, the way we have to do the business today is to accelerate growth and no escape if you want to pay the full price.
And I guess focusing on growth and the best practice of a firm is your playground, Michele.
Yes, although I have to say we are probably more of the second category of people in terms of looking at how to deal with a high price situation. I guess we probably the fact that we were born in the first investment was made in March 2000 and at the peak of the internet bubble, and we went through a double dip, let's say recession in Italy between 2009 and 2011 has made us very conscious of assuming, as François is saying, it's not necessarily what you assume, because you can also assume a market discount when you sell. But certainly we have been burned in the past in assuming that the current situation will stand for a long time. So we still are looking for opportunities that are a little bit off the market. And we try, I mean, the last 5 investments we made, I think we had reasonable entry prices, also because they were made during most of them were made during the COVID crisis, and clearly that is a moment in which you can be a contrarian more than in this time. But going back to your question, yes, I mean growth is important. Although I still think that together with growth, you're bound to have some multiple expansion because I think the gap has narrowed now. But as you invest in companies that have maybe, in our case, 5 to 7, 8 million CBDA when we entry, and through organic growth and add-on acquisition, they get to the 15, 20 million level, then you're probably going to have a different kind of set of people looking at your company, and you can, not that you should factor it in at the time of your investment, but you can benefit from some of that. So that in the short.
And it helps you in pricing at the beginning. We will come back maybe at the way you price the strategic value perspectives and the way you anticipate all this work you do then in the portfolio. Fabrice, Michele just talked about helping a company going from 8 million EBITDA to 15. And actually, I think at France Invest you have a quite famous study every year, especially talking about value creation in 300, something like that, companies backed by PE people. What are the 2021 results?
Yeah, absolutely. Thank you. Good afternoon to everyone. At France Invest, we represent approximately 400 GPs that invest across categories of private assets. So we have a fairly extensive and detailed view of this question of value creation. And in addition to that, as you said, we have numbers to share. Each year since 2012, we've conducted a study together with Ernst & Young on value creation in portfolio companies. And actually, the 2021 study will be released in a few weeks, so I have to cite...
so you have to tease us.
Yeah, I have to tease a bit, but the results have been fairly consistent in the past. They clearly go against the cliché, that many people still have about private equity, which is that the value creation comes from the use of leverage and excessive leverage, sometimes at the expense of growth, of investments, of R&D, of jobs. The study that we conduct and that looks at approximately 300 deals each year shows very, very clear and very simple things on value creation. It shows that value creation comes from, for 2/3 from EBITDA growth. So that's very, very clear, and I will come back to that in a second. And for 1/3 from multiple expansion, from the improvement in the long-term perspective on a company. And nothing comes from leverage or deleveraging. So 2/3 EBITDA growth, 1/3 improvement in the multiple. Zooming on the EBITDA growth, what's interesting is that, again, it's not cost-cutting, layoffs, etc. It's really 90% driven by top-line growth. And in this 90%, it's 2/3 organic growth, 1/3 M&A. So it clearly shows that PE funds have an active role to play. Basically, you can sum up this complicated study by saying, okay, value creation equals top-line growth. And we can cross-check that. We've done another study with Inuo, which compares the growth in PE-backed companies versus family-owned companies in the same sector, same size, etc. PE-backed companies grow twice as fast, 14% per annum on average versus 7%. So it clearly shows that private equity funds drive value creation. And of course, I'm sure my two colleagues here have very concrete examples to share.
So you mean that maybe tomorrow we won't value a company with EBITDA but with top line?
Would be easier. Why not?
less transaction services. Even if it's
frankly, let's talk about EBITDA as the main metrics in valuations. It is clearly something that is used by the industry overall. it's not the right figure to watch. I mean, you should be really watching at the capacity of company to really create cash, and so you should be watching at EBIT or normalized EBIT or whatever you want as the main metrics. It's just, we always, you're bound to have to look at the EBITDA because all the rest of the world is doing at that. But clearly, a company makes 10 million of EBITDA, but has 6 million of capital expenditure each year to obtain that. Is very different from a company that has no need of capex, right?
François, do you feel the same about EBITDA?
Of course, we can only share that because as we use leverage, also at some point we need to reimburse that at some point, so having also profit. But however, it's of course it's a mix as usual. Focus on growth is also key. Just because if you buy a company going by 20% each year, it means that after 2 years, if you have made the right choice, you pay the cheap price. So that's why it's a good mix between a good balance to find, even in a portfolio. I assume it's the same for you. You have to find some companies that are, let's say, maybe more secure for part of them, more limited growth but high cash generative approach, and some with strong potential in terms of growth, to find the right risk-reward balance that are expected by our investors.
No, you're right, and you actually had a very good point. Which is the EBITDA you're looking at when you say what multiple you pay the company? I mean, if you buy a company in October or in December, what are you looking at next year, this year? If it grows 20%. So, I mean, that's also, you can really twist the numbers in a lot of different ways when you define how much you pay the company for. But the reality is that it's a little bit more complicated than just putting a multiple on the EBITDA, right?
Playing the numbers is it's the rule of the game anyway, no? But let's dig into the value creation. When you talk to when you work on small to medium companies, how do you practically really support in terms of operations, in terms of strategy, especially companies who have to embrace new markets and to operate quick evolutions or revolutions? We will maybe talk with Michele just after about the focus strategy also, but maybe to François and to Fabrice, how do you support them really operationally and in the everyday job?
So first of all, if we state that we invest to boost the company, we need first to secure the fact that the ground are safe and are strong.
The fundamentals.
The fundamentals, absolutely. So it means that in most of our investment cases, we invest in primary transaction. 2/3 of our investment at 21 in France. So it means that we need to very often structure, institutionalize, to move from, let's say, family-run companies globally to management-run companies before having an acceleration in terms of growth. So it means that the first months are critical even to structure, so that when you decide with the management team to accelerate, you are safe in the way to do it. Because if it is just to accelerate and then having a few months after the evidence that it is too quick, you lose a lot of time. In our business, losing time is also detrimental. So that's why for us the first thing we have to do and that we provide is a real work alongside the management teams. And the first thing to do, as an example, that was not done in France, I don't know in Italy, but for HR reviews for SMEs were something that were considered as a bit intrusive, let's say 10 years ago. Now it is something that is for us obvious. It is performed systematically. And the management teams agree to do that because they want to go also quick, but with the right pattern. And so the first thing is to secure, for me, the structure. It can be people, it can be processes, organization. So it can take, let's say, 6 to 18 months according to the companies. And this is only when we have that we can accelerate. So the first thing for me is that.
So first work the fundamentals, HR, operations, and process. Fabrice?
Yeah, I mean, to add to that, I will cite another study or white paper published by France Invest this morning. I'm not all about numbers, but
now
today I have a
now
lot
it's
of
a big
numbers.
release. Now it's okay.
No, so we have an operating partners commission at France Invest to reflect the increasing role of operating partners in funds and in value creation. And this morning they published a white paper which is quite interesting. I encourage you to go to the website of France Invest and to download it and to read it. And the interesting point is that we looked at I think 80 of the largest LBO funds in France. So that's not all of them, but a large number. And close to 50% of them have at least one operating partner, and this number is increasing very, very rapidly. So it shows that I mean, this active involvement in very specific topics. I mean, you mentioned HR, but there are also technical topics, and is increasingly important and is increasingly a driver of value creation.
And because Fabrice, in addition to your role at France Invest, you also you work at FL. What are the first thing, and maybe it's open to the three of you, and then we will go with Michele on the focus strategy, but what's the first thing you launch in the first 100 days, the very famous 100 days where you feel like it's you make or break, but what do you do first, even in terms of people, how do you do the first meetings with the management after the deal is concluded, when the historical owner maybe is out for the first real time? How do you tackle these moments?
Well, at Eiffel, I mean, we do a lot of things, but our private equity fund is centered around the energy transition. So it's a very specific sector that requires a lot of technical expertise. And it's also a sector that is growing very fast. I mean, you know, it's a race between the different players to develop renewable energy, to develop clean mobility infrastructure, etc. And so our focus at the moment is really how do we help those companies that are usually when we start quite small. And the last, I mean, one company in which we invested a few months ago had 2 permanent employees to when we started. The idea is to multiply that by 100. So we have to hire an incredible number of people. So we have to help them with that. We have to help them with prioritizing the project on which they work. So there is no you know, preset plan for the first 100 days. It really depends on each specific situation, but it's a lot about okay, how do we unlock the growth? And I agree with François, a lot of that relates to HR.
In our case, I have to say, as important as the first 100 days, and maybe more important, are the 100 days before the transaction. So we really want to close the deals when with a clear view with the management team being, because we are equally involved in management buy-in and management buy-out. So clearly the situation is very different if it is a buy-in than a buy-out. But clearly you really want to start planning even before the transaction, and hopefully you're not in one of those very tight and competitive processes, which we never seem to be able to buy companies from. Also for these reasons, I would assume we really want to know the situation and talk to the management a lot before. But yes, I agree with Fabrice. I mean, there's not a single issue. I mean, I think strengthening the management team, filling the gaps in terms of skills that are not present in the company. One other thing that is very important is scouting right away the market for potential add-on acquisitions. So discussing with the management team what would be the interesting companies to approach, because that's clearly something that's one of the things that changes the most when you enter into a company that was entrepreneurial and you have a private equity investors. I mean, it opens up a lot of possibilities from the add-on acquisition, things that maybe the entrepreneur didn't have the courage to do by himself, or maybe just they didn't have a good relationship with the other entrepreneurs. And so starting from day one to think about what could be the value adding acquisition is also very important. And frankly, lately it's also an ESG plan, because it's it's not just cosmetics anymore. It is a real way to involve the company and in things that are becoming more and more important, both for the clients and clearly potentially increasing your top line, but also in terms of the positioning of the company when you sell it. In terms of multiples on EBITDA that a buyer can recognize to you when you exit.
And you regularly advise your portfolio companies not to diversificate, you told me. So it's not about not doing something, it's about doing right the core business of the company. And it goes very well with the build-up strategy you just mentioned. So at Wise, is it wise to focus on the core business and not to diversificate?
Well, that has to do with the size of our companies and the type of companies we invest in. Maybe I should say that we are typically an investor in what we call niche leaders. These are companies that are extremely good at doing something very specific. So most of our portfolio companies are companies with maybe revenues in the range from 50 to 100 million, that are world leader in doing something very, very vertical. And we believe that these companies have a clear strategic value when we invest that goes beyond the result, the financial results. And that's probably a way also to lower the risk in a way, because if something goes wrong and the company doesn't grow, it's difficult to find a buyer for a company that doesn't have a strategic value like these ones. So, thinking that we invest in this kind of companies, we help them to focus on what they do well. So for us, it is important to continue to do and to do even more what the company does well, and maybe not focus anymore on something that the company is just a me too. So we had examples of companies that one of our most successful investments was a company in the inks for textile, both for screen printing and digital printing, and it was 50-50 in terms of revenues when we bought it. As we bought it, we separated the digital printing facility from the screen printing that was more a Me Too product, while the digital printing, this company was the largest in the world. We sold the screen printing part, and we made 4 acquisitions to really make the screen printing, the digital printing section become even stronger. And we opened a subsidiary in the US with a plant there. So we did a lot of things, and that's the kind of thing we like to do. Another example, the company that I follow myself, it is a company in the boat sector. We invested about 1 year ago, and this company historically is the largest manufacturer of sailing boats in Italy. Amazingly, I am a sailor. I love sailing boats. Unfortunately, the market for boats is 90% power boats and 10% sailing boats. And these guys are all passionate sailors. And 4 years ago, they had the idea to launch a powerboat segment. At that moment, 4 years ago, the company was doing 15 million of revenues in sailing boats. Now, after 4 years, they do 15 million of revenue in sailing boats and 80 million of revenues in powerboats. But when we entered, and we talked about product development and the new products coming to the market, 2/3 were sailing boats, and that represented not only 20% of the revenues, but probably 10% of the gross margin. So clearly, that's another example. We clearly don't want to stop doing sailing boats. We need to invest, but probably more 50-50 or 40-60, and let them focus on what they do really well right now.
And when we talk about, because Michele just talked about build-ups, it's a subject where 21 is very comfortable. I think just on DL Software, maybe you had like, what, 8, 9 build-ups? François?
Yeah, just before jumping in the build-up subject, I think I don't like very much the idea to oppose diversification and focus. Because we need both, indeed. If you need innovation. To innovate, you need to take risk, to explore new opportunities of development for the company. So typically, I think we need to have a good balance, having diversification, as soon as it is strategic. In our case, we have one example in a company, Product Life Group, which is a specialist that was initially based in France and in Europe for managing legal and pharmacovigilance for pharmaceutical groups. And you need to be in the US at some time because 50% of the market is based in the US. So at some point we have decided to make an acquisition. It was but in the US. So it's a diversification in terms of geography, but it was strategic and definitely I think we need to find a balance. So that's why for us it's a matter of mix. On buy and build, to come to your initial question, is one of the way to go quicker. If you want to go in the US, starting just with one commercial guy, and then second, etc., you move from. It's too long. So it means that the advantage of using this buy and build strategy is that you can go quicker. But if your structure is safe, because it's also a risk, so you need to structure first, institutionalize the company, and therefore you can move abroad, or you can move to test new markets with new products or new services. So yes, we like it, and DL Software is one example that we structured a platform in the software industry. In France, it was a small company initially, around a bit less than 10 million euros of EBITDA, and we sold it this year. It was more than 20 million. It was a mix with organic growth, 6% per year, but also with strong buy and build, with having made today more than 10 acquisitions for this company. So it's a matter of balance as usual, but it's a way to go quicker. And time is of essence in our business.
Before going on the governance subject, we talk about time for the second time in the conference. Do you think 4 to 5 years is enough? Because we're talking about value creation in the portfolio. With GP-led transaction and in the large cap, we can see that sometimes some lines are kept in the fund or a new fund for more years. Do you think maybe in 10 years we will see longer funds in terms of period and maybe 8, 9, 10, 12 years to develop an asset?
I don't believe so, but maybe I'm wrong. I don't believe so, just because it is the question of what are the expectations of our clients. The clients and private equity is already in terms of asset class very long. It's 10 years of fund plus 2, so it means at least 12 years. And if you compare that to public market, it's very, very long. So, but I suspect that will be more companies, and DL Software is a good example, that you have in one fund. And if growth and potential is there, you can propose to your investors to make a new investment in a subsequent fund. And this is what we did. We sold it and came back alongside to a new private equity fund to benefit from also the new step the new phase of growth we are thinking about.
And DL is not the only deal you've done in the last years, but we talk a lot. I think you already doubled since the operation in terms of EBITDA now, or something like that. It grew so much since you made the decision to stay with new investors.
Hopefully, it's not the same. It's a new story. So yes, it's true that it's through buy and build. We knew that we had the opportunity to continue the development, but at some point it was also relevant for our investors to take the profit, because at some point we are investors, and it cannot be only a potential value creation in terms of NAV. It has to be also in terms of cash. So at some point, yes, we did that way.
Yes.
Yeah. So we frankly never felt constrained in terms of timing. So I do agree completely with Francois. I think, by the way, funds are already lasting 15, 16 years. I mean, if you look at the average life of the fund today, I think that is the average that you find. Not our case, but I think, typically the companies that go well are taking even less than 4 or 5 years to develop a lot of value. It is true that you may have 1 or 2 companies in each vintage that would probably need a few more years. It can happen. But frankly, the industry now has a lot of ways to deal with it. I think continuation funds and things like that are completely standard. So, if you can't do that with all the funds, but if you have 1 exception out of the 10 companies in your funds, I think that's completely reasonable. And it's actually a good way to continue to add value for your investors.
Fabrice?
Yeah, in the energy transition, it might be a bit different. It's a sector that is very capex intensive, very heavy industrial investments, projects that take a very long time to develop. So in our case, our fund is natively a bit longer than the traditional PE fund. So it's a bit in between PE and infrastructure in a way. And interestingly, if you look at the unicorns that have emerged in this sector of the energy transition, even in France, the likes of Neoen, Voltalia, Accio, etc. They do not have PE shareholders. They have family offices, which clearly shows that you need animals that have a bit more time, and that's why in our case we built a fund that has 15 years, and when you discuss with the management team, with the shareholder, it's a key selling point to tell them, okay, we'll not talk to you about the exit in 5 years' time. We can take longer.
Thank you, Fabrice. Have you identified, since the last years and months, and especially last month, where everything has been changing so fast, of course, expectation from the consumers, but also the rise of ESG, and it's not a rise, it's a rocket for ESG, and it's for good. Have you identified new creation levers, or levers that will actually be preeminent in the next years to develop value in the portfolio? That's a 1 million question, maybe more.
1 billion.
1 billion.
Yeah.
Yeah. 10 trillion if you take into account the whole private equity worldwide industry.
I see your point, but I don't believe in hidden things. Our business is to support companies, and companies are in their market for years, and it's not a new matter. So it's just a matter of evolution. A few years ago, it would have been digitalization. Now it is, let's say, common, but however, very important to support them in this evolution. And so I don't believe that there is some hidden levers. It's just to apply the right ones at the right moment that is, for me, critical for those SMEs. We are in SMEs. It's not venture, where you have it's leveraged buyout for SMEs. Discipline, deploying with discipline to support the companies in the long term is, in my view, more critical.
I think you know, especially thinking about what happened in the last 18 months, I think that there is clearly an element of thinking when you look at the company, how is the industry that the company operates in being affected by the situation, and it is clear that there are some industries that are clear winners in terms of you know, increase in we invested during the pandemic in a couple of bicycle components company, and you know, probably have seen an increase in demand that we didn't even expect at that point. So that's important. But I think in terms of one of the things that is going to be important in the next few years is clearly the E part of ESG. So, you know, with all the climate change, you know, buzz and everything, I think if you push your companies to focus on what they can do in that direction, you're going to have a double effect both on sales and on the strategic value of your company, because this is, you know, we have one company which produces tower lights that are used to temporary construction sites or events or these kind of things. And clearly, during COVID, the company had a few months in which revenues were 50% down, because it's a capital expenditure for our clients, and nobody was buying them at that point. Everybody reduced their capital expenditure, and the company took time to develop a range of products that are mostly solar or hybrid, and now we have the most advanced product range in that field. And because of that, when we are talking to advisors now, the company recovered very well, and we are talking to advisors for an exit. We are getting feedback that this company could be worth much more than we thought, because it can be sold with that kind of angle.
So ESG, creating, in addition to success, it's creating EBITDA multiple expansion.
Well, two things. In some industry, it's going to affect also the
top line, also
the sales.
Yeah,
the sales, because there are clients that want to have products.
But for example, have you experienced in past deals, of course, not this one, which is ongoing, but have you experienced like some figures about multiple expansion that have been possible through ESG politics and strategy?
This is a provocative question. No.
A friend of yours, maybe.
What has really changed, in my opinion, is that it is becoming from something that maybe in the past, especially for small companies, used to be a tick-the-box exercise, to something that clearly can change the profile of your company, right? But no, you know, the short answer is not until now.
Maybe it will, for sure. Fabrice, François, on this subject?
I mean, on ESG at France Invest, we have a very active ESG commission that mixes GPs and LPs, and you know, taking a different angle. What LPs tell us very clearly, and I'm not sure we're listening, but they tell us very clearly that they will not invest in the future in companies that underperform from an ESG perspective, and it's coming very, very fast. You know, there is this new taxonomy and SFDR, etc. Directive. It's a very, very profound change, and so first it's a risk, and okay, they will stop investing. They cannot invest in companies that underperform, but it's also an opportunity, because of course, as private equity, we are in the driving seat, so we can drive, we can steer the transformations of the companies, and so we can create value with ESG, which is something that you know, investors in public equities or other asset classes might have more difficulty to do. So we are in a position to create opportunities, to create value, and this is very. I mean, we need to do very simple things. this subject of ESG is very complex for a SME. The CEO doesn't have time to look at it. It's a lot of regulation, a lot of jargon, a lot of, seems very complex from the outside. And so our responsibility, our role, and again, at France Invest in this ESG commission, we try to develop very simple tools that GP can use to transform their portfolio companies. One example of one very simple and almost stupid thing we do at Eiffel is every time we invest in a new SME that doesn't measure its carbon footprint yet, we help them do their first carbon footprint assessment, and we pay for it. Because sometimes, the CEO will tell you, don't have the time, it's too expensive, complicated. So we identify the consultant that can help, and we paid whatever, a few thousand euros, and we paid from the management fees of the management company, by the way, not from the fund. And it initiates a mind shift, in the management team, and they say, okay, it was not so complicated, and we see low-hanging fruits in terms of carbon emission savings, etc. And they start from there, and you've initiated something that will create value, that will increase your exit multiple.
Yes, definitely. That's why for me it's not a hidden lever. It's something. It's a wave coming.
You don't like the word hidden. Sorry, François. I won't use it again.
Wave. It's a wave coming now from years, and we can see it. It's right that initially it was reporting matters, but it was a good way to start, because when you report, you state. You can identify gaps that you have to bridge, and then you just make it happen, and that's why this wave now we are in, and I think that we can support and help them to do that, and to make a comment also what you said, Michele, initially, that we start ESG matters and reports before the deal, when you are assessing the investment, and then the best thing is that you deploy it just in the 100 days during this period where you are ready, the entrepreneur is ready as well, it's paid by the transaction indeed, and then you can initiate. So I think that typically it's something that is moving forward, and that we support a lot as investors.
And maybe that's one of the wonderful new, not hidden, but new ways to crystallize the partnership between a GP and management, because of course management, they have some trends about their own market, but you're bringing something truly important about ESG. Do you have any question in the room? Because I guess we're almost timed out. Don't be shy. Yes.
Thank you for the question. I think it's very good, and I think on this, you're bound to have a very different approach depending on what size of the market you're in. We clearly, we manage a slightly more than 250 million funds right now. We wouldn't have the resources to have operating partners that specifically manage portfolio companies. But frankly, we do believe that that kind of involvement is key to add value to portfolio companies. So the way we tackle that is we are also operating partners, and we have operating investment managers. So the profile of people working for us are not really financial. Most of the people that work for us, both partner investment managers, have a managerial background or a management consulting background. And there are a few people here, and so we typically hire people from McKinsey, BCG, Lauren Berger, Bain, and that is the kind of background which we believe is important to back on a daily basis our managers. On top of that, we like to involve industry experts as independent board members, typically people that have have had managerial position in that specific industry in the past, because they also provide a nice sounding board to the management. So, you know, for a small fund, I think that's what you can do. If you're a much larger fund, you can, you know, you have a P&L in which you can hire people to, you know, being a logistic manager and a pricing guy and do a lot of things.
And at 21, we are in between. Let's say that we name them operating advisors. They are part of our supervisory board of the management company. And then when we make assessment of an opportunity, they have some sector expertise, and we use them for their sector expertise. So they can participate to the management presentation, and then they have the opportunity also to contribute to the board. And we offer them to co-invest alongside us if they are provided, let's say, some support on also if the managers and the entrepreneurs agree to have their contribution in their own board.
And maybe to mix the question of this gentleman, do you have ESG operating partners or operating advisors dedicated to ESG and to these matters?
No, today it is for sector expertise. However, you know, it's as usual, our role is to propose the toolbox to our entrepreneurs and managers. So as soon as you have a request, digitalization, environmental matters, we can find the right the
right person for the right management and team.
Same approach for us. I mean, we do have a consultant that helps us with the more administrative part of the job, but we try to create a culture between partners and investment managers too. So we wouldn't want to outsource that kind of function to a dedicated person. We would want that everybody has an ESG part of his mind when we follow the company. Otherwise, you're going to have the deal people that think one thing and then the ESG person that thinks another thing. It's more important to have it all in one person.
And actually, the next panel, I think, in the upstairs room is ESG strategy, one vehicle or one commitment for the whole fund. So if you want to go on this subject, do not hesitate, it's on the first floor. But just right here, we will talk about pricing, valuation, and leverage. Is sky the limit in a few minutes? Because right now we don't see any wall or any roof. But let's meet in 15 minutes just here for this last panel, because just before you have a small break for coffee and chit chat. Thank you very much.